Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello everyone, welcome to the Through the Noise podcast. Since the start of Q3, major asset classes have reflected a cautiously optimistic market sentiment. Global equities are up more than 6%, while global bonds have faced challenges in delivering positive returns. Gold, meanwhile, has stood out with double-digit gains. With the Chief Investment Office having just released their October's global market outlook, I'm joined today by Manpreet Gill, our Africa, Middle East, and Europe CIO, to share our latest perspectives and explore emerging investment opportunities. Hi Manpreet. With signs of a weaker U.S. labor market, what is your view on the U.S. economic growth going forward, and what is the expected Fed's interest rate trajectory?
Hi, Michelle. Indeed, it's an interesting time to have this macro conversation. Now, our base case is still that the U.S. economy achieves a soft landing. So we expect U.S. economic growth to slow a little bit below its long-term trend level of around 1.8% over the coming year, as the highest import tariffs in almost a century and policy uncertainty, start to hurt consumer and business confidence, job creation, and real wages. Having said that, we still believe the economy is likely to avoid a recession because a lot of those negatives are offset by the impact of tax cuts and corporate investment incentives, which are coming from Trump's one big beautiful bill, and of course the resumption of Fed rate cuts, which we think will start to kick in fairly soon. Now, we do expect the Fed to cut twice more by 25 bips at each meeting later this year by the end of 2025 and twice more again in 2026. Now, that cumulatively starts to bring policy rates closer by the end of these rate cuts, much closer to the Fed's own estimate of a neutral level, which they estimate to be in the region of 3%. So with trade tensions largely contained, we think the focus will turn to deregulation in sectors like banking, energy, and other sectors. And when you combine that with the fiscal stimulus, what is turning out to be a weak dollar and lower Fed rates, we think all of that can really help lift consumer business spending and support that growth picture to achieve a soft landing.
Got it. So the global equity markets has actually risen by quite a lot in Q3. So from an asset allocation perspective, do we still expect global equities to outperform across other asset classes?
Absolutely, we do. So if we take that macro picture we just discussed and combine it with where financial markets are, we still think there's a strong case to remain overweight global equities over bonds and cash. Now, that soft landing we described for the U.S. economy, that outlook, and together with significant policy support outside the U.S. as well, these remain key assumptions behind our expectation that corporate earnings will continue to grow at a fair clip. Now, we've heard the pessimists. They've argued that we have quite a few risks out there. We have potential event risk from the U.S. government shutdown threat. We have elevated equity market valuations, and September, October can be seasonally volatile periods. And there's some question marks over investor positioning as well. However, while we wouldn't rule out some short-term volatility or perhaps just consolidation, we think a lot of those negatives will be outweighed by still strong fundamental indicators that should balance out that negative case. I mean, if we look at our own long-term quantitative stock bond model, for example, which incorporates fundamentals as well as technicals and valuation, that still strongly favors stocks over bonds.
Got it. So given a more bullish stance that we have still on the global equities front, are there any specific regions that we prefer?
So one region we prefer is Asia ex-Japan. We're overweight the region based on expectation of both a weak US dollar, but also continued policy support, which we're seeing emerge more so in the larger markets of China and India. So within Asia, we do also hold a relative overweight to Chinese equities, preferring offshore markets, given what are proving to be fairly growth-supportive policies. India, of course, more of a core holding within that Asia ex-Japan overweight. Now, Asia is, of course, one preferred region. The other one is the US, which we're upgrading to an overweight this month. Now, the US has witnessed pretty resilient earnings momentum after the last earnings season, and that, of course, continues to be led by the AI-related sectors. So this, together with the Fed rate cut that we witnessed, as well as the ones we expect later this year, these support our soft landing view for the economy. And that's why we expect US equities to also outperform global equities over the next 6 to 12 months, despite having a view that the US dollar will be weak.
Okay, got it. So just now you've just mentioned about a weaker dollar view. So let's shift gear back to the FX and also the bonds market. What are our expectation of the dollar and how would that impact the bond market?
So on the dollar, we still expect the US dollar to remain weak. And we think that, of course, is likely to occur amid that growing evidence of a softening labor markets and, of course, resulting in the Fed rate cuts we described. So we think that can push the US dollar index, what's commonly known as the DXY index, a little bit lower from here to 96.5 over the next 3 months and down to 95 over 6 to 12 months. Now, continued US dollar weakness and expectation of that means for bond markets, that's one big driver behind our overweight for emerging market local currency bonds. So in an environment where downward pressure on the dollar persists, we continue to see value in holding that tilt to non-US dollar bonds. Because one is the currency exposure, of course, but besides that, what we think is interesting about EM local currency bonds is that we also expect rate cuts, and they also tend to lend some support. As we've seen in several emerging markets already, a rising need for policy support to support growth, of course, and what's been muted inflation in many such markets and reduced worries about the currency mean that central banks have much more room to cut rates, which should be an additional tailwind for the asset class. So that's our overweight, and we're balancing that with, of course, an underweight in US and European high yield bonds, which, of course, face much more elevated valuations. So that's perhaps a bigger sort of bond preference. I would add that when it comes to multi-asset income allocations, other views that we think where we're positive is on U.S. mortgage-backed securities and subordinated financial bonds. The government bond-like credit quality and yield premium over government bonds, we think will help support the performance of mortgage-backed securities. And subordinated financial, we acknowledge valuations are elevated relative to history and increasingly so versus other major bonds, but still we think there's sufficient relative value there, given that elevated valuations are a challenge across most types of corporate bonds. So happy to earn the yield here.
Okay, so there is also one last question about the commodities market. Do we see any further upside on gold?
Absolutely. We can't have a conversation without markets today without talking about gold. And the answer is yes, we're adding to a gold allocation and moving that to an overweight as well. Now, the precious metal has continued to record quite strong gains since it broke above its tight trading range in September. In our view, those gains have room to extend. And that's led both by a resumption of central bank reserve diversification demand as well as a weak US dollar. So, 6 to 12 months out, we now expect gold to rise to $4,100 per ounce. But even over a shorter horizon, we believe gold offers some attractive hedge characteristics against some of the major risks that we're keeping a watch on. So, for example, any risks of a rebound in inflation worries, short-term equity volatility, or indeed any new unexpected policy events.
Got it. So that wraps up today's session. A big thank you to Manpreet for sharing with us his valuable insights, and to all of our listeners for tuning in. If you'd like to get updated from the latest investment trends, don't forget to like and subscribe. We'll be back next week with more market perspectives. See you then.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.